Hi, thanks for jumping in with us. We were doing a walkthrough of S56 this morning with Katie and folks just sort of wanted more run through of the other portion of the bill. So we'd love if you could.
Thank you. For the record, Abby Shepherd, Office of Legislative Counsel. I am going to just start sharing my screen. These sections that I'll be walking you through start on, there's sections 24 through section 35, which is towards the end of the bill. It starts on page 36. Just going to pull that up on the screen. So all of this language is highlighted in yellow because it is different from the other versions that have been proposed, but not necessarily from what this committee has seen. What I've walked you through was sort of orphan separate language. It's now been put into the overall amendment, which I know my colleague Katie McLinn has been walking you through. So the first change in, sure. Is that large enough?
That is fantastic.
Slightly on a delay when I'm scrolling. There it is. Okay, great. So the first change is for taxable year 24. So that would be when individuals are filing in calendar year 25. And the first change is to increase the different personal income tax rates. And they are increased as income progresses through the marginal brackets and through the marginal rates. So the first lowest income bracket is increased at a smaller amount than the highest income bracket. So you'll see here, the language directs our office to make updates to the statutes, to the rates themselves, not to the actual income brackets, because those are adjusted for inflation every year. So we won't actually know until this fall what those income amounts will be. Or since this is for tax year 24, it would be for next fall. So those are updated every year by the Commissioner of Taxes. So the first increase will be from 3.35% to 3.65%. The second taxable income bracket rate will be increased from 6.6 to 7.3. There are four marginal rates for the personal income tax brackets. So there's 7.6% will be increased to 8.3. And then the highest marginal rate will be, instead of 8.75%, it will be 9.6. So those rates apply irrespective of the filing status. So it's just that the income amounts are different depending on the filing status. And then in subsection B, it directs our Office of Legislative Counsel to revise the tables in statute. I don't know if there are any other questions on how that actually, like the mechanics of how that operates. Be happy to explain any part of that.
Representative Bodie?
I think I understand it, but I would love it if you would just give us like an example, because I'm getting questions. Taxpayer and what they might pay. Like if you were a senior citizen and you were getting Social Security, some kind of thing that I could.
I think that's a JFO question.
So, well, yes and no. So an individual taxpayer situation is really going to vary depending on adjustments to income, any credits or exemptions. You mentioned Social Security in particular, and there is a Social Security exemption, but it depends on income. So it's, in that case, they should, I don't want to say they should speak to a CPA or someone else, but this isn't existing law yet. So it's kind of, might be challenging for them, but they would probably want to speak to an individual because we could look at their individual situation.
Yeah, I think just to follow up on what Abby said, I think Patrick actually put together a nice chart with different income brackets. I can give them a baseline to be like, all right, this is what happens if I follow it. And there's different filing statuses and whatnot in there. So I think that'd be helpful.
Madam Chair, so
Do we have a plan yet on what we're gonna use this money for when we collect it in 25?
So the personal income tax goes into the general fund. So it's, this language doesn't direct it specifically to any given purpose, but yes, so whatever the appropriations would be at that time from the general fund.
So we collect it in 2025.
Correct, which would be fiscal year 26.
Yes, that's right.
Sorry, fiscal year 25, sorry. And then it would continue into fiscal year 26, but it would start in fiscal year 25, would be the second half.
Okay, so any changes we made to the preschool program or the daycare program couldn't start then until the next fiscal year, right? Because we wouldn't have collected the money yet.
So individuals would start filing and paying under these new rates in calendar year 25, which is the second half of fiscal year 25. So whenever the revenues would be booked, that's when they could start being used for, if childcare were the purpose, which certainly this bill would direct it towards. Yes, so, yes, I hope that answers your question.
Yeah, it does. So I'm just thinking that's down the road a ways and we don't even have a specific place for that. I mean, I think in the general design, all of us around the table have an idea of what this money would go for, but we don't have a specific goal enumerated in the bill. Is that necessary?
So, well, you couldn't appropriate it in this bill because that's in a future fiscal year. So you would need to make the actual appropriation in that fiscal year budget bill.
Okay.
But in terms of where the spending is happening, I haven't been working on that part of the bill, so I can really only speak to the revenue.
Pat has a chart, Pat and Joyce have a pretty endless series of charts on that, but there's one that's sort of similar that talks about money going in, money going out in fiscal years. So, and certainly all of the money, the amount of money that's sort of being spent year over year because of policy changes in this bill matches up with projections of money being raised in this bill. But you're right, there's no special fund or anything like that, if that's what you're referring to. Yeah.
And yes, I remember the chart that they've made. So is that chart how we're going to communicate to future legislatures when to initiate the different aspects of this plan?
So all of the changes in policy that have spending implications are all in this bill, so they'll go into effect. So the need for that money will be there in future, like the increase to CCFAP is in this bill, and that then is, and that happens for, like, explaining itself very well.
It might be nice to have that chart again, to sort of stack all the pieces and total dollar amount and align it with.
Yeah, we can do that again. But the policy changes in here that raise the CCFAP rate don't have end dates on them, and, so that would be the spending in future years, it's already built into here. So we'd have to change this law if we weren't appropriating.
Thank you.
Is that where you're going?
I'm getting questions about how the money would all fit with how the needs for the program, can be fixed. So I think that starts to answer that question. Thank you. I would like to see that chart again.
Yeah.
That's the 7-year one? Yeah, okay.
We can have Pat come back.
Okay, thanks.
Yes, but my understanding is the way these are phased in is to line up with that phase in of the program needs for funding. So you do have this first tax year 24 increase that would begin at the end of fiscal year 25. And then you have a second increase in the rates. And it's the same exact format. It's also a progressive rate increase. So as income increases, the amount of the tax rate increase also increases. And that would begin in taxable year 27. So the revenues would be available in fiscal year 28 or calendar year 28, if that's easier to think about in terms of the impact on individual taxpayers as well.
And I think I did read somewhere, maybe it's in this bill, that in 28, we would start using that money that is collected in 27. So that one is clear. And I still wonder about when future legislators are going to know about the 25, 26 money. But I'll wait till I see that chart again.
Okay.
I'm sure that'll be.
I would defer to JFO for explaining also the, the forecasting process, how the legislature would know how much revenue would be available. It's its own sort of budgetary process. I'm not the best place to speak about that because I work on more raising revenue. So I don't know if there are any other questions about the language of how the tax rates would be increased. I know it's a lot of words, but it's really saying go in to statute, change these rates. And then once you have the new inflated income brackets, those would also be updated in statute. So it's a lot of language for some ministerial tasks and additionally for the tax department to have the authority to impose new rates and update their forms. The corporate income tax changes, you don't see the effective date here because in this case, it's actually amending the statute that shows the rates. But this would also take effect at the same time as the first personal income tax rate change. So it's in tax year 24. So the revenues are available in fiscal year 25. And again, the increase in the tax rates is progressive as the brackets of income increase. So the 3 current rates, which are imposed on Vermont net income of a corporation. So again, this is only C corporations, and this is income that is allocable or apportionable to Vermont. So when we say net income, that's profits. And this does not change the minimum tax amount on C corporations. So the first rate would be increased from 6% to 6.5%. The second rate would be increased from 7% to 8%. And the third marginal rate would be increased from 8.5% to 10%.
So these don't have 2 steps like the personal income tax, just 1 step.
Do you mean by step?
Well, like we do it in 24 and then again in 20.
That's right.
8?
27. Yes, it's a one
Yes,
time.
one.
Someone else asked that question the other day, and we just didn't, but we could if like that symmetry feels helpful.
I did.
You did, thank
It
you.
would be a lot less pages, wouldn't
It'd be more pages.
Could be more pages, could be more words.
it? Sorry, never mind.
We could just like cut random sections out of
I have some ideas.
But that symmetry seems, I don't think it would raise all that much. We can see how much more money it will raise if it's sort of worth the pages.
It would raise less money, wouldn't it?
Depending on how you do it.
If there was
What
steps.
would you say, a lot or not a lot?
It would raise less money.
Oh, I was thinking steps, like there was sort of the second trigger where it would go up again.
Oh, you wanna go beyond what?
I really was not purposely misunderstanding, I really was.
Leave it like it is. Sorry.
The next changes are structured both, so it's amending 2 different credits. So there's the earned income tax credit and the child tax credit. And there are some more technical changes and then policy changes that do have a revenue impact. So the first change that you see here is more of a policy change, which would allow individuals who do not, or individual spouses or children who do not have a qualifying taxpayer ID number, so a social security number or an ITIN, they would be eligible to claim the Vermont Earned Income Tax Credit under this language. And then the second change here you'll see on lines 10 and 12. On page 40. that crosses out the phase out of the credit that's based on earned income currently. It would make it just based on income, and seems like a very technical change. It is to line up the EITC with the way that the child tax credit was enacted last session, so that it's just looking at income and it's not specific to earned income. So that was a request from the department to line up these different tax credits. This section, these amendments to the EITC would take effect retroactive to the start of this taxable year, so they will be available for taxpayers when they file in 2024. The second amendment in section 28, sort of the second phase of amendments to the EITC, the earned income tax credit, relate back to the personal income tax rate increase that you saw for tax year 24. So you'll see language here. If you were to go look at the statute right now and compare it to this, it would not line up because this section 28 is assuming section 27 has already taken effect. So it has the language about individuals who do not have taxpayer ID numbers being able to claim. So this is now amending future statute. And this is where the change to the credit amount is made. So rather than it being a 38% credit of the federal credit, it is now being split for taxpayers based on whether they claim a qualifying child or not. And I would like to point out that I have corrected my error. I apologize for my testimony last time that it flipped the percentage amounts. So you'll see it should be the correct policy choice where you would like an individual who claims a child who qualifies for the EITC, they would get a 55% credit. And if they do not have any qualifying children, it would be 100% credit. And 100% again is what the federal credit would be if they had a taxpayer ID number.
I'm just remembering that the sort of dollar amount is still usually higher for children, even though we're changing those percentages.
That's correct. Okay.
It's just so counterintuitive.
Yes.
I say it to myself over and over again.
Okay. Okay, so this section 29 is in, and you don't see the heading there because of the way it's drafted, but this is in the child tax credit. And I will just pause to remind the committee that the Senate proposal, as it came out of the Senate for S56, did propose to repeal the child tax credit. This amendment does not have any repeal. Instead, it is making some changes to the existing child tax credit. So the first change is to line up the child tax credit would be the same as the language for the EITC. It would allow taxpayers to claim the credit irrespective of whether they have a taxpayer identification number or whether or not their spouse or child has a taxpayer identification number. This amendment would take effect retroactive to the start of this tax year. So claimants in 24 would be able to take the credit even if they don't have a taxpayer ID number. Section 30 is relating to this proposal to allow individuals to claim the EITC and the child tax credit without taxpayer ID numbers. And it requires the Commissioner of Taxes to provide a process for individuals to claim these credits. And it requires the commissioner not to inquire about or record the citizenship and immigration status of an individual, their spouse, or any of their qualifying children. It does allow the commissioner, makes it clear that the commissioner can request identifying documents to establish an individual, their spouse or their child's identity and their income for the taxable year. And it does require the individual to notify the commissioner if they are in the future issued a social security number. And then lastly, there is a subsection C that really just repeats existing law, but makes it very clear that any claims or records that are created or submitted in the process of claiming EITC or the child tax credit will be exempt both from Public Records Act inspection, public inspection and copying, but also there is existing tax confidentiality statute that prohibits the department from disclosing tax return or return information. So this repeats that and makes it clear that this process would be subject to those protections.
And that's like not even belts and suspenders, it's just like making sure that people who read this know that that's there.
Yes. My reading is that it is not legally necessary, but it is clarifying language. Section 31 of the bill is still within the child tax credit. And other changes to those two sections because it deals with a very different issue. And you would see if you looked at the effective date for this section 31, it is contingent. So this is amending statute. When I say contingent, it means it doesn't take effect right away. A different sort of trigger needs to take place for this section subdivision of statute to actually become law. And it requires the Commissioner of Taxes to start an advance payment program of the child tax credit. It will be structured similarly to the child tax credit payments that were made by the federal government during the pandemic. So it would be a 50% of the annual credit would be paid out quarterly, and they would be made in equal amounts. And it sort of lays out how the commissioner would administer it. It does authorize the commissioner to request information and to ensure that the credit amount is the correct amount. It also requires the commissioner to allow for an individual to opt out. So the individuals wouldn't, so they would be receiving advance payments unless they decided not to. So I won't skip ahead, but yes.
This was like a lifetime ago. And maybe I'm totally misremembering this, but I remember when the commissioner was in here at the beginning of the year talking about this, I felt like I remember him saying that they don't currently do anything like this and it would be a lot to set up a quarterly payment process and it would be like pretty modest amount that would be spread out over quarters.
So when we originally had the tax credit bill last year, this was a big part of our sort of conversation in the committee with the tax commissioner, that it was sort of important to the committee to have those payments as like best policy of mirroring the federal child tax credit. And it was in conference that we sort of let it go. And we've had an opportunity for Ledge Council to do a lot more research on sort of what the contingencies would need to be to make it work. But that, like, in terms of how the and we haven't really taken any testimony on this, but last year we took a lot of testimony on sort of the national policy and the national research on how the child tax credits were getting spent. And the quarterly would have a very sort of different impact on people's lives, even at a small dollar amount.
And there are contingencies to ensure that tax can set up a system like this, or is that something?
They absolutely can, in fact. What was interesting last biennium is that sort of parallel to the commissioner saying this was challenging, the office was also, the department was also interested in sending property tax refunds to folks. So yes, also, they can do it. But certainly they need time to set it up and it would need to be a project.
So I'm not going to skip ahead here, but just to point out, in the effective date, it is contingent and it does allow for at least 1 quarter, so 1 fiscal year quarter of time to pass after federal action is taken for the department to implement this program. And the federal action that is required for this to kick in and become law in Vermont is that one or all of the different federal public assistance programs, so that includes SNAP, Supplemental Nutrition Assistance Program, WIC, so Special Supplemental Nutrition Program for Women, Infants, and Children, as well as there's a whole slew of different federal public assistance programs, several of which have requirements that make state refundable income tax credits, like the child tax credit. They consider that income if it's received not in one lump sum. So it's really the advance payment aspect that would make this type of payment be considered income for federal benefit programs. So it's not so much that a state refundable credit is always included income, it's just when it's paid out more than once a year. So if that requirement to include these payments in income were in some way abrogated or repealed federally, then this would take effect, but the department would have at least 1 or 2 quarters, depending on when that federal action took place, for the department to implement a new program. Okay. That is Those are all of the changes that would be made within personal income tax for the rate changes and then the credit changes. There is now another proposal that does impact personal income taxes, but it's more geared towards pass-through entities. So this is moving most of, with some slight changes, the language that was passed out of the Senate in S45. So it creates a workaround for the state and local tax deduction cap, which exists at the federal level, which was imposed starting in 2018 by the Tax Cuts and Jobs Act, and currently is set to be repealed or sunsetted at the end of 2025. And so I don't know if you want me to refresh everyone's memory as to what the cap is and then how the workarounds function, if that's too much detail for.
I think that's too much detail for this moment, but we can have GFO discuss that.
Okay, the changes from what you've seen when there were discussions in here and testimony on the S45, so just referring to it as the SALT cap workaround. So we don't have to all say state and local deduction cap, because it's that $10,000 cap for filers at the federal level where you can't deduct more than that when you have state and local taxes. And again, that applies to itemized filers, itemized deduction filers. Other states have created these workarounds so that pass-through entities can take the full taxes imposed on the pass-through entity, and then that deduction is taken at the federal level. Those benefits flow through to the individuals, and then the individuals are able to claim a state tax credit against the tax that the pass-through paid at the state level. And what is different in this language from S45 is primarily the amount of the credit that the individuals can take. So instead of 90%, this is a slightly smaller credit in this version. It's 87.5%. So that's the primary change. I also, at the request of the tax department, did change some of the types of members. There have been some questions about both what types of pass-through entities are considered eligible pass-throughs and whether or not they would be considered members and able to take the credit. So this language now has clarifying language around single member LLCs are not pass-through entities that could pay this tax and then pass it through, because it's just one individual. So there's no pass-through. It's the individual, and so it's like a sole proprietor. However, if a single member LLC who is disregarded, so they are considered like a sole proprietor at the federal level for tax purposes, they could be considered a member of a pass-through entity. So they would be able to take the credit, but they could not themselves be the entity that's paying the tax. So there are a couple of really small little things, as well as, there's also a grantor trust, which is a very similar structure. I'm trying to find this definition, sorry.
It's okay.
Spoke through it, okay. Also a grantor trust that is a trust created by the grantor, and the grantor is receiving all of the income. Same thing, where it's the entity and the individual are almost indistinguishable for tax purposes. Those are the only changes from S45 that you have seen previously. And then I could walk you through the effective dates, but I assume you are set on those for the sections.
Okay, thank you, Abby.
Yes. Oh, I'm sorry. And just in the effective dates, I just wanted to point out that as passed out of the Senate, the SALT deduction cap workaround would be repealed whenever the federal repeal takes effect. So this is not a permanent provision. Thanks.
Those who feel guilty.
Thank you very much, Abby.
Thanks.
Switching gears entirely. S 135. An act related to the establishment of remote stadiums. Becky. Welcome club. Hi. Would you like to sit down and tell us about the
Your diet's awkwardly walking around with the treasure.
I'm sorry. that kind of thing, isn't it?
I'm joining Zoom, right?
Yes, please,
Okay.
thank you. And we can be pretty high level with this, and we're hearing from CFO.
There.
A nice little like interstitial moment.
Nice to have it be quiet.
And now we will.
Nothing to do with you.
Becky Wasserman, Legislative Counsel. S-135 is an act relating to the establishment of the Vermont Saves program. So Section 1 is establishing a new chapter to create the Vermont Saves program. And what this program is doing, it is requiring certain employers, and there's a definition of who is covered, it's mandatory for them to offer this retirement savings program to their employees. So that part is mandatory. The employee does have an option to opt out, but they are automatically sort of enrolled and then can opt out. And there is an initial contribution level that the program starts at 5%, but then the employee does have an option to opt out altogether, contribute at a lower or a higher amount. And go into more detail in the language, but I just wanted to give an overview of sort of what the program is doing. In terms of definitions, unless you want me to go through all of them, I'll just kind of note ones that I think are important. For covered employee, covered employee, so who's covered? It's an individual who's 18 years of age or older, who's employed by a covered employer, and who has wages or other compensation that are allocable to the state during the calendar year. So a covered employee may include part-time, seasonal, or temporary employees. That is will be determined pursuant to the treasurer adopting a rule on that issue. Covered employees don't include employees that are covered under the Federal Railway Labor Act, any person who's employed by federal, state, or municipal governments or instrumentalities of the state, and any employee whose employer makes contributions to a Taft-Hartley multi-employer pension trust fund. And a covered employer is essentially any person or entity that is doing business in the state. And that can be a profit or nonprofit entity. If they have not offered to their employee within that calendar year or the 2 preceding calendar years a specified tax favored retirement plan. So that's what gets you sort of caught as a covered employer under this program. And then covered employees don't include any sort of federal, state, municipal government, or an employer that hasn't been in business during the current calendar year and the preceding calendar year. So I will sort of make some guesses as to what the committee wants to hear, but you can feel free to stop me at any time.
Can you tell us about the tax saver stuff?
So this specified tax favored retirement plan. So the definition of a covered employer says that unless you've offered one of these plans to your employees within the last 2 years, then you're covered by this program. And these are programs that qualify under the Internal Revenue Code as to be specified tax favored retirement plans. I can get back to you with what all of these are if you want that specific information. I don't. Then in terms of, there is a fund that's set up in this program, the Vermont Retirement Security Fund. It has its own section, which I'll get to. And that fund is used for the purpose of paying administrative costs and expenses of the program. Section 532 is establishing the program, which is administered by the State Treasurer's Office. And the purpose of the program is to increase financial security for Vermonters by providing them access to an IRA if their employer does not currently offer one. And the program is supposed to be designed to facilitate portability of benefits through withdrawals, rollovers, and direct transfers of IRA, and achieve economies of scale and other efficiencies to minimize costs. And so on page 6 here is where you'll see that the program allows a covered employee to contribute to an IRA, and that can be done through a payroll deduction. And then in subdivision 2, it's requiring that each covered employer offer to the employees their choice to contribute with that opportunity to opt out. In subsection,
Does the employer?
the employer pay in, there is language, I'll get to that in a second. The short answer is no, the employer cannot pay into it because that implicates ERISA. And so this is supposed to be sort of not, for federal tax reasons, we don't want ERISA involved. So the type of IRA is a Roth IRA, but the treasurer is authorized to add an option for participants to elect to contribute to a traditional IRA instead. And then under subsection C, the contributions, I mentioned earlier that the sort of initial automatic contribution is 5% of the employee's salary or wages, and that employee can elect to opt out or contribute at a higher or lower rate. In subdivision 2, the treasurer is directed to annually increase this contribution rate, and it's by not less than 1% and not more than 8% of salary or wages each year. And the employee does have the opportunity to opt out of that increase as well. And then on line 9, it says, provided that any increase is subject to the IRA contribution and eligibility limits applicable under the Internal Revenue Code. And that's because there is a limit of $6,500 that can be contributed in 1 year, in a calendar year. So subdivision 4 is also what I just mentioned, that says contributions by a covered employer are not required or permitted under the program. And in subdivision 5, this language is saying that each participant in the program owns their contributions and earnings under the program, and the state and the employer have no proprietary interest in those contributions or earnings. Page 8, the administration of the program. The treasurer administers the program, and the treasurer is authorized to contract with a vendor to assist with administration of the program. The program has to be designed in a way that is consistent with federal law and making sure that the payroll deductions and covered employers are not subject to ERISA. In subdivision 2, the costs and expenses associated with administering the program can be defrayed from investment returns or assets of the program through fees, charges, or funds to the extent permitted under federal and state law. And there is a fee subsection, which I will get to in a moment. There's a lot of language in this bill, both here and in a rulemaking section, that talk about all the sort of processes and requirements that the treasurer has to do to set up this program. So this is just sort of listing a number of things that are required, such as, processes for enrolling participants and contributions to the IRA, and processes for phasing in enrollment of eligible individuals, how participants can make non-payroll contributions to the accounts, processes for an employer to be determined to be exempt from the program because they are already offering a specified tax favored retirement plan, as well as that issue I discussed earlier about the determination of whether part-time, seasonal, or temporary employees are covered and eligible to participate. Subsection E talks about the records and accounting required for setting up this program. And I would just note that one of the points here is that how this is set up, the accounts should be set up in a way that allow participants to maintain their account regardless of their place of employment, so that they can have portability to if they leave that employer. Page 10, there's an annual reporting requirement that the treasurer has to send out reports to participants each year on the status of their account. And participants also are required to have access online to their account information. Subsection G, the treasurer is required to do some outreach to the public, individuals, employers, stakeholders about the program and the required disclosures that are the disclosures required under the program. Participant accounts, the participant is the interest and all the earnings and losses are allocated to participants' individual retirement accounts, and their benefit under the program is equal to the balance in their account as of any applicable date that the treasurer uses to measure that. In terms of the assets of the program, and maybe I should pause, I feel like I'm going kind of fast. Are there any questions? No? Okay. The treasurer is authorized to establish a trust or custodial account to hold the assets of this program, the assets and investments of the program. And the trust is considered an instrumentality of the state and not subject to ERISA. Subdivision 2 says that
assets are the investment proceeds from the assets, the property of the fund, or are they transferred to the general fund?
So in subdivision 2, it says no assets of the program or the fund can be transferred to the general fund or any other fund of the state or encumbered for any other purpose.
I don't know whether this is, well, anyway, I'll ask it, you can tell me. One concern is that with the opt-out, they have to opt out, which means that they'll begin receiving this, or money will begin to be deposited into a Roth IRA. And then after 3 months, the employer realizes, or employee looks at their paycheck and says, oh, I'd like to opt out. I didn't know you were doing this. I want to opt out. But if it's a Roth, it's harder to get out of it.
I don't know if that's a question for Becky or for the treasurer.
Okay.
I think the treasurer's office can speak to the timing of when an employee can opt out, as well as how that process would work. And I think that is based on what other states have been doing. So they have done some work with other states to see how it's working there. But also these are processes that need to be set up. So I think they can speak to that better than I can.
Okay.
This is an optional program for both employer and employee.
It's optional for the employee. It's required for the employer. And I'll get there, but there are some penalties for the employer not enrolling employees or not following the requirements of the program.
Okay, and in about 2 sentences or less, can you remind me what ERISA is? I know it comes when you're separating from the job. but I feel like that's.
I don't know that I'm the best person to explain the intricacies of ERISA, so
Yes.
I think the treasurer's office might be able to speak to that a little bit better than I can.
Okay, all right.
Back to you, Becky.
So the contributions to an IRA under the program can only be used to pay the benefits to participants, the cost of administering the program, or to make any investments for the benefits of the program. I think of interest to this committee, there is a fee section here. The treasurer may require that participants be charged a fee to defray program costs, and the treasurer has the authority to determine the amount and method of collection of such fee, but there is a maximum amount of $30 per participant in each calendar year. And employers are not required to fund or be responsible for collecting fees from participants. Section 533, the duties of the treasurer under the program. So as I mentioned, there's a number of sort of rulemaking and other authorities given to the treasurer just to set up and implement this program. So the treasurer can adopt rules about the distribution of funds from the program and promoting portability of benefits. About participants' initial contributions and the investments, the required investments that will be made into a default investment, or the ability of a participant to choose a different investment for those contributions. The treasurer is also authorized to make and enter into contracts and agreements with other governmental entities that maintain or are establishing retirement savings programs that are compatible with this program, to essentially allow for effective and efficient administration of the programs together. And the treasurer can use a sole source or simplified bid process for that purpose.
What's an example of what that might be?
So again, I think this is a question that the treasurer can answer better, but my understanding is that the way this program will work is that they're looking to enter into agreements with other states that have similar programs that are already set up to sort of, combine efficiencies to.
So if I came from another state that already had something like this, then I could like roll it over.
Oh, no, I think more sort of for administration purposes. So sort of efficiencies of scale of the technology and services that are being provided to operate the program. The treasurer can contract with, financial institutions, investment advisors and managers, and other administrative and experts, advisors and service providers to administer the program. They will set up criteria and guidelines to offer qualified retirement investment choices. And the treasurer will have rules about the program and accounts that are established to be sort of operating in accordance with best practices for a retirement savings account, and make sure that they avoid preemption of the program by federal law. The treasurer can apply for any grants or gifts or other, funds to defray program costs.
Vicki, I feel aware that you have a time limit on those here. So ask the member from the committee, is it okay if we go a little bit faster? Does that feel okay for you, Vicki?
That feels fine. I'll just note here, there is language that the treasurer, this might be of interest to the committee, can enter into agreements with the tax department to facilitate sort of checking eligibility for employers and employees and sharing tax return information to verify wages. So I can sort of skip through the rest of the duties of the treasurer. Section 534 is establishing the fund that the treasurer's administering, which goes into any funds appropriated or transferred into the fund, and any payment of fees, penalties, and other money that's due to the program. Section 535, as I mentioned, there are some penalties. If a covered employer fails to enroll an employee without reasonable cause, they would be subject to a penalty, which is there's a penalty schedule set out in the bill. So prior to October 1st, 2021, that would be a penalty of $10 per covered employee. Between October 1st, 2025 and ending September 30th, 2026, it would be a max of $20 per covered employee. And then after October 1st, 2026, that increases to $75 per employee. I won't go into all this language, but there is authority for the treasurer to waive that penalty for employers that fail to enroll employees under certain situations.
Is there a reason why we make that a maximum instead of just a firm number?
I think let's just usually have fines to borrow.
Excuse me?
Sorry.
I think there's some discretion on, it's giving some discretion on the part of the treasurer's office. I think you could make it a set amount, which would be less discretionary for the treasurer.
Okay.
Because there is this waiver rule, I think an interpretation of the waiver language is that they're trying to sort of minimize penalties where possible if employers are trying to comply with the requirements of the program. So I think maybe the maximum penalty is just another way of having discretion over, if somebody, if an employer was trying to comply, but, the reason they failed to comply was maybe a less egregious reason, then they would sort of set the penalty in accordance with that.
Okay.
But of course you could change that.
Yeah, it's just, well, anytime you allow discretion, you allow for the possibility of bias by the person who's doing the discretion.
Right. So this is allowing discretion. So,
okay.
Yeah. The protection from liability, there are some protections from the employer from liability, as well as the treasurer and the program, essentially saying that, the employer's not considered fiduciary in relation to the program, and they're not liable for the employee's decision to participate or opt out, or if they have any losses in their account and their investment decisions. And then similar protections for the state that, they're not responsible for an individual's compliance with federal law. And, they have no liability for, the payment of any benefits under the program, and they're not guaranteeing any investment performance. Section 537, confidentiality. The treasurer is going to establish policies to ensure that there's confidentiality of participants' personal and confidential information. There is a reporting requirement that the treasurer report back to legislative committees on how the program is operating every year. And then Section 2 of the bill is an implementation schedule for the program. So this is subject to an appropriation from the General Assembly. Currently, there is a $750,000 appropriation in the budget for this program. So with that appropriation, the program would be implemented with this schedule. So beginning July 1st, 2025, covered employees with 25 or more covered employers with 25 or more covered employees have to offer the program to all employees. January 1st, 2026, that covers the employers with 15 to 24 employees. And then after July 1st, 2026, all covered employers with 5 to 14 covered employees have to offer the program. Section 3 is repealing the Green Mountain Secure Retirement Plan, which was enacted about 5 years ago and didn't really move forward. So this is taking the place of that. And then Section 4 is the effective date. So this would take effect on July 1st, 2023.
Thank you very much.
Sorry, that's very fast. Are there any questions?
Apparently not. Thank you. Treasurer Pichek, do you want to join us? Do you want to wait for a computer there for a minute? Okay, thank you. Worried about your power problem.
Good afternoon. Yeah, thank you very much. Thanks for having me. I think maybe just be useful to maybe answer some of the questions that I heard, make sure that we get some answers, but also just generally about the program. You know, we're really sort of targeting a group of people that just don't have access to a retirement vehicle at the moment. They're working, they're in the workforce, they don't know who to turn to or, you know, how to set up a program for themselves. There's sort of this inertia of not having a retirement savings program, not saving for retirement. And the other states that have implemented this program have found that that inertia basically switches once people are voluntarily into a program like this, and they stay in it and they continue to save and they accumulate assets, which is a really good thing. This population, 88,000 to 104,000 is the estimate. They're generally overrepresented by younger people, people that are less educated, people that are lower wage earners, women more than men, BIPOC populations overrepresented. So it's really a group of people that we want to provide a vehicle to and a way for them to build a sustainable future in retirement for themselves. So, you know, we're really excited about that, excited about the success in the other states. They found that about 70 to 75% of employees stay opted into the program. And then when you look on a year over year basis, it's more like 95% plus stay in the program. So that sort of gets to that inertia point that once people are in, you know, they generally stay in. And then the only other thing I want to mention before getting into the questions, in 2027, one of the other things that we're really excited about is that the federal government is revising their federal savers credit program. So starting in 2027, if you are saving in a qualified retirement plan, which these plans would be as Roth IRAs, and you're below a certain income threshold, the federal government has sort of defined that as like $70,000 or so, then you could be eligible for up to a $2,000 match into your retirement account, depending on how much you're saving and how much you're putting away for retirement. So you could imagine someone making $40,000 or $50,000, putting the maximum in and getting an additional $2,000 on an annual basis starting in 2027 from the federal government. So we really want, yes, we want to set up as many Vermonters as possible to be able to take advantage of that program. So the timelines would get us there. The timelines in the bill would get us there and have it operational by then, which we're excited about. To answer Representative Taylor's question, you know, about sort of what does an employee that 3 months in sort of reevaluates the decision and wants to make a new decision. So a couple of things that from an operational standpoint, when an employee is eligible for the program, they'll get a communication from the vendor that says, you know, you're eligible to opt out of Vermont Saves over the next 30 days. You know, this is what the program is. These are the benefits. These are the responsibilities. They'll get an email as they get closer to the 30 days. Once the 30 days hits, they'll be notified that a Roth IRA has been set up for them and they'll have payroll deductions. Other states, which I think is a good idea, put those monies for another 30 days into like a money market account or a very stable account and allow the employee to witness that money has been taken out of their account. And then when that time period is up, so that's sort of 60 days from the eligibility time period, then it will get deposited, will be in the Roth IRA, but it'll get reinvested into a target date fund that most closely aligns with that person's retirement. And at any point, somebody can stop contributing to the program. And with a Roth IRA, you can take out your principal without penalty, tax, or other penalties that would be assessed. Your income, your monies that you earn on that principal would have to stay in the Roth IRA consistent with whatever your retirement, and age qualifications are. So it operates.
Can you start that sentence again?
Yeah, for sure. So the Roth IRA, one of the reasons we are going in that direction in the bill is because of the flexibility that it provides individuals. So if you put $1,000 in and then you say, wait a minute, I don't want to participate in this program. I'm going to I'm only going to stop. Not only am I going to stop contributing, but I'm going to pull my $1,000 out. Let's say you have an emergency and you need $500 because you have a car repair. You can pull out $500 of that $1,000. But say that $1,000 earns $100 over that time period, that $100 would have to stay in the Roth IRA until you're eligible to pull it out, free of tax and penalty consequences once you hit a certain age. You could take it out early, that $100, but be subject to tax and penalty. But the principal can come out.
At certain ages, like 65.
Yeah, right.
Okay.
Other products like the traditional IRA, you don't get that sort of flexibility because it's a pre-tax program. The Roth IRA is post-tax, and that's why you're able to pull out the principal that you put in. So you don't necessarily want people to pull out their retirement, but it is a good piece of flexibility in case they need to make that car repair or they don't get to work and they risk losing their job. There's other circumstances where that flexibility is really useful. So the primary purpose of it is a retirement vehicle, but the secondary purpose is like an emergency savings account. And then Representative Brannigan asked about the Employer Retirement Income Security Act. So just generally, ERISA, as Becky pointed out, very complicated. A lot of people specialize their whole careers in ERISA, but it was created to protect individuals' retirement, pensions, healthcare, when an employer or somebody else are making those kind of important decisions about what is the plan going to be invested in, how much money is being contributed into the plan. There were situations prior to 1974 where corporations went bankrupt and they didn't have sufficient funds in their pension system. And the federal government wanted to fix that and protect that. So that they, as a corporation, had certain fiduciary responsibilities, they had certain accounting and recording obligations. And it's a great program for those companies, that are large and have a lot of money and a lot of people that are being impacted. In this case, the individual person has control over their Roth IRA and their investments. And we want to try to avoid implications from ERISA because it would only add complexity and cost to this sort of low cost efficient program. So that's sort of why it's drafted in the way that it is.
Do the employers get anything for this?
So the employers don't have any cost to them in terms of participating in the program.
Yeah.
They do have to sign up for the program if they don't otherwise offer a retirement plan. So if you offer a 401k or a simple IRA or have a pension system, then you're exempt from having to participate. But if you don't offer one of those retirement plans, then we do require you to participate. And that's the key thing that drives this and makes it successful, is that those individual employees might not know how to sign up. They don't know where to turn to, but the employer acting in a position of being, more stable, more sophisticated, potentially from a financial standpoint or from a operational standpoint, being able to go in and sign up in Vermont VT Saves. It's a 4-step process. Basically you take control of your account, you put your contact information, you put your payroll information, you put your bank account information, then you put your individual employees' information as well. The other states that have recently implemented have said that they didn't have an employer that took more than 15 minutes to sign up and claim their account. And then if they don't have an automatic payroll process, it took them a few minutes every payroll period to confirm and hit send to make it work. So it's a relatively limited administrative burden on the employer. We've heard from employers in other states, and the Vermont Businesses for Social Responsibility have echoed this in Vermont, that there is a benefit to employers to having this low cost and efficient retirement savings that they can offer to their employees, just as a general benefit as we look around other states that maybe don't offer this.
Well, I can see that it would improve their quality of life as these people get older and leave the workforce, without a doubt. Will the employers complain to us about this?
That they're retiring too early?
Well, yes, but I was thinking about the extra work, the 15 minutes times the number of employees.
Right. We haven't heard any, no business groups that we've met with are opposing the legislation. I'll put it that way. The burden, there is a slight administrative requirement, right? There's no doubt about that. But the other side of the equation, in terms of the benefit to the individual, I think are so enormous that it outweighs that, that process. There's also benefit long-term to the state of Vermont. Not only is it not a program that doesn't cost money on an ongoing basis to administer, but the hope is 10 years, 15 years, 20 years, 30 years, that there's less dependence and reliance on state benefits because people have a more stable and secure retirement on their own. And even if they're only able to, let's say that somebody's maybe in their 50s and they start now and they save $40,000 in Vermont saves by the time they get to, 62. Maybe they're thinking about retiring, but they're able to spend their Vermont Saves money for a year and delay taking Social Security until age 63. That's a 7 to 8% additional increase to your Social Security check every single year of your life if you delay it 1 year. If you can delay it 2 years, it's another, between 7 and 8%, all the way up to the maximum. So even folks that are later in their careers could still really benefit from having a vehicle like this to help them save and supplement their retirement.
So lastly, I'm thinking that probably what I think of as middle-level employers already have something. So I'm thinking of people that have 10 employees or 20 employees or something. But people who have less than that, a diner that runs only in the summer, or a guy who sells seedlings and trees and stuff like that seasonally, they probably don't have a retirement program, but they might have, when they're open, 10 or 12 employees. Are these the kind of people that qualify for this?
So on the employer side, the size question, if you're an employer with less than 5 employees, you're not required to participate in the program.
Okay.
You can participate in the program. It's voluntary for that group. We're trying to follow in the footsteps of other states that have been successful, and no other state has implemented all the way down to 1 employee yet. They all have implemented to 5 and then made it voluntary. The state of Oregon is going all the way down to 1. So it's something that we're looking at closely to see how that goes. But that includes an independent contractor or someone that's a sole proprietor. They could participate and maybe find the benefit of a lower cost investment option for them. So that's on the employer side. On the seasonal or part-time, we do want access. We want as many people to be covered as possible. But some of that is going to come down to rulemaking, which the bill gives us the ability and the discretion to do, to make sure we're not, we're make sure that we're making smart decisions around who to cover and who not to cover when it comes to part-time and seasonal workers. So we'll work closely with business groups, we'll work closely with other stakeholders to do that rulemaking process to make sure we're striking the right balance and covering the right folks.
You decide where to invest this?
So the investments, there's basically 2 third-party contractors that will be necessary, 2 vendors. One of them is a vendor that works with the employer, that gets them signed up, that gets their payroll coordinated, that sets up the Roth IRA for the individual employee. And then there'll be an investment vendor that's sort of, think of like Fidelity or State Street or someone that's really significant and expert in this. And they'll provide a suite of target date funds that will allow the investor, the employee, to choose between maybe one of 6 or 7 options, like a stable account or stable fund, like a market fund that doesn't really have much risk, a 10-year target fund that maybe has more weighted towards fixed assets than equities, 20-year target date, a 30-year, 40-year target date, depending on their target date of retirement. So there is a variety, but it's intentionally limited both to not provide an overwhelming number of choices, but also to keep the costs low as well.
Can't think of any reason we wouldn't want to do this.
No, we're very excited about it.
Did the governor think?
Well, there are 12 other states that have implemented it, right? So that's the other thing that gives us confidence is that it's been successfully implemented elsewhere.
And we put something, we put this idea of this retirement accounting statute quite a number of years ago.
Right.
And think you'd struggle to get off the ground, so I really appreciate you.
Yeah, and this,
We have 5.
Oh, sorry.
And I see that people have questions, and I also want to make sure that if there's anything you want to share with us that's outside of our questions, you have a chance to do that.
I think I did cover in the beginning the most important points.
I just want to say, I think this is a great idea. And for, you know, a lot of young folks, particularly those who don't have anyone who are advising them.
Right.
Any sort of leadership on this type of thing. Going out into the marketplace and trying to figure out where, what, there's a vast marketplace out there for this type of thing, and it's overwhelming.
It is overwhelming.
For someone who doesn't have any guidance or doesn't know what to do, this could be a real save for them, particularly if they don't, know about things like compounding interest.
Exactly, yeah.
I think, I don't know what the other states have done, but I think this account platform will give you an opportunity to do that sort of financial literacy outreach.
Yes.
To some of these folks, which I think would also be a great.
Yeah, I mean, it's in some ways, I was mentioning to Representative Odie, it's almost a interactive financial literacy program because I think those are the best kind. Not only are you teaching, retirement and the benefits of retiring and the difference between a Roth IRA and others and the importance of leaving your money in rather than taking it out, even if there's an emergency, but you're actually providing the vehicle to do it as well. So it's not just academic, it's action also. So that outreach person will be critical. We'll hope to work with other stakeholders like the AARP to get the word out about the benefits of the program and the ability to save in the program and the benefits of saving long-term in the program as well.
Thanks for your leadership on this.
Well, thank you.
Representative Maslin.
Yeah, thanks. I think between the two of you, you've covered some important bases. I think interactive financial literacy program is spot on. And I think as we all recognize, there's a lot of inertia out there around this sort of subject because how do we do this?
Right.
How do we do this, Go eat another hot dog instead. I mean, I'm being a little sarcastic, I'm afraid, but apologize for that. But it's spot on.
Yeah. And
I do like hot dogs and I don't hurt anyhow, so.
Okay.
If only.
Just to that point about inertia, the other thing that we've heard from other states is that there are a lot of businesses that maybe are 20 or 30 employees and they themselves as a business have thought, oh, I want to provide retirement to my employees, but they put it off in terms of creating a structure and so they can be in Vermont Saves or they've seen an uptick of 401k or simple IRA formation. So that's great as well. They don't need to participate in this as long as there's the access to retirement.
I appreciate that you've done your spade work ahead of time to figure out what would be sensible for individual employees. Great as John, you asked a lot of good
Yeah, for sure.
questions. So Peter, not Tony, but Anthony.
Comes great to ask good questions too.
Anyway, a lot of spade work questions that done in advance of people wondering what like. So good. Thank you.
Representative Odie, and then Sims. And then what?
For as if they have a 401k or other plan, do you have a minimum quality plan that they have to have in order not to be an employer, not to have to?
Oh, to be exempt. Yeah, we were asked that question, previous testimony and, the way I would think about it is, it's not inexpensive to set up a 401k and there are requirements around contributions from the employer as well. Because of the expense and complexity of setting up a 401k and because of the obligations that the employer is taking on, both financial and risk, it almost by definition will mean it's a 401k that's quite legitimate if someone's doing that, is my point.
Okay, so, and then going to one employee, I like what Oregon's done. So you'd have to come before us again?
Yeah.
Think about that.
For sure. They're in the middle of implementing it, so we'd like to see, them be successful. And then we have a 2-year ramp up to get the vendor to do the hiring we need to do the rulemaking, to do the spot processing and pilot programs to make sure it's operational. So in that time period, we'll be able to analyze what Oregon has done and the success that they've had or what challenges they've had.
Well, thank you. And the last part is, in rulemaking, are you hoping to go toward being able to cover seasonal and part-time people?
Yeah, I mean, that's why we wanted the discretion. We just, those become a lot of like fact-specific circumstances that we want to have the ability to be thoughtful about and make sure we're covering people as broadly as we can without running afoul of things we're not thinking about.
Absolutely. Okay,
Yeah.
thank you.
Yeah, for sure.
Great, thank you. Thank you for this.
I'm just gonna jump on the praise bandwagon. It's worked out a bunch of like tiny nonprofits that have never been afforded the opportunity to easily enroll in.
Yeah.
Just, many of my peers and neighbors and friends, could have really benefited from the set it and forget it.
Right.
That this will hopefully make, that will make a really big difference from ours, and excited to hear about the opportunity to take advantage of maybe future federal free lunches.
Yes, yeah, exactly right.
Glad we're doing this right now to be ready.
And the ability, we've mentioned a couple of times that sort of younger people, right? And, you hear a lot of stories about people that in their 20s maybe were at a job or an occupation where they didn't have retirement. Then eventually maybe they found a job that they did, and then they're in a 401k, later in life. And they say, boy, I wish I had, if I hadn't missed out in my 20s. And so this would also fix that problem, right? Even if you're only able to save a few $1,000s, that's sort of the average that we're seeing in other states, for all of those years that you're able to, plus potentially with federal money, and then over the rest of your.
Don't remind me what I've missed out.
But yeah, I think it's just an important point.
With other states and in the future, is this going to impact the unclaimed property fund? Is this where it would roll over to if somebody doesn't end up claiming their retirement?
I see what you're saying. So so it's it's potential that if, some point in the future, an individual unfortunately passes away or something like that, and the beneficiaries don't claim it. I mean, it is their money. It is their estate's money. So it'd either go to the beneficiaries, or in the situation where they couldn't find their beneficiaries, or they didn't claim it, potentially could go to unclaimed property.
Such deep, interesting detail about it. Very lucky back in lots of things.
And there was a question about the penalty Representative Taylor asked too. I just want to mention, the other states have a penalty also. And they told us that it's really important from their perspective to have one. But of the 12 states that have done this program, and there's 6 that are operational now, there's 6 that are in the process of making it operational. They told us at the most recent treasurer's meeting that there hasn't been a single penalty issued against an employer. It really was just a backstop to get people into compliance. And to your point about sort of that discretion piece, we do want discretion, but we're going to have rulemaking. So we will limit ourselves in terms of the discretion. We'll have to follow our own rules that will go through the normal rulemaking process with ICAR and LCAR, and then be enacted.
Thank you so much for joining us.
Yeah, no, thank you very much for making the time, especially so late in the session.
And thanks for rearranging 4 times too.
Oh, it's all good. Thank you. I'm just glad to be able to be here. Well, thank you.
Fantastic.
Join us for a moment in the
Thanks, Chris.
spotlight.
Sure.
Good afternoon, everybody. Chris Roop from the Joint Fiscal Office. You've got an interesting afternoon. You go from childcare to retirement, cradle to grave committee. I have very little to add to what you all heard. There is a fiscal note posted under my name, but it is a brief one. Most of it sort of rehashes the high level description of the program that you already heard. But I just want to really mention a few things in terms of how this bill would impact the revenues of the state. As introduced, the bill carried a $750,000 one-time general fund appropriation to get the program up and running. Once the program is up and running, it would be sustained through those fees charged against the participants, which the bill would cap at $30 per participant per year. So the thinking would be, once the program's up and running, with the help of that $750,000, then it would be moving and basically be self-funded through the participants moving forward. The bill, when it went through Senate Appropriations, as is their common custom, they amended the bill to strip out the appropriation because they alternatively reflected it in their budget. So you will see it in the B1100 sections of the Senate budget. It is currently up for discussion in the broader budget conversation. The bill has introduced also authorized the creation of up to 3 new positions to get the program up and running. Senate Appropriations Committee, along with the appropriation, remove those positions. And the intent would be, if this legislation moves forward, that money and the positions could then be reflected in the budget, where we typically reflect all the other one-time appropriations and positions. So that is the fiscal note in a nutshell.
So no impact on revenue in the state. That's
No impact.
Okay. Thank you all very much.
Thank you, Chris.
Yes, sorry.
Do you have a figure for the 3 covered employees?
Off the top of my head, I don't. My understanding is there were the immediate need is 2 to get things up and running. And I don't know if the treasurer has that off the top of his head, but when you figure salary and benefits, you're probably in the low to mid $100,000 per person.
Yes.
Just a comment, Chris, this is the committee to be in this time of year. We're never bored. Things come in over the transom under the door, you know, it's a lively place.
Our agenda changes every half hour.
No moss grows on any of you. My pleasure.
Madam Chair, motion that we vote out S-135 with a favorable recommendation.
Second.
Oh, we're all excited. Were you guys second?
I was.
Okay, Representative Demo moved that we find 135 favorable, and Representative Andrews seconded. Any discussion? Happy, good. So clerk, please call the roll.
Andrews, yes. Anthony,
Yes.
Beck,
Yes.
Brian,
Yes.
Deborah,
Yes.
Jocelyn.
Yep.
Meadows.
Yep.
Bodie,
Yes.
Sims.
Yes.
Taylor. Canfield,
Yes.
Kornheiser. A resounding 12-0-0.
Thank you very much. Thank you.
Thank you very much.
So next up, because the moss doesn't grow, Representative Marcotte is bringing us an amendment to S-94, which is on the floor for second reading at 3 o'clock. And Saoirse, could you share your screen so we can see the amendment? Yeah. Welcome.
Good afternoon, Madam Chair. Good afternoon, committee. We had taken this up last week. We did a drive-by, so we're in the same position you are. But this is a great program. We're looking forward to it. In any event, S-94. So I have
We have the language up behind your head.
So I have a very small amendment. This comes about, I think, in discussions with one of my committee members who also sits on the BEPSI board. They had a meeting last week and saw their agenda. There was no mention of an executive session on it. There was one business that was applying for a veggie grant. And they did go into executive session. And so I find it possibly problematic that they weren't posting that on their agenda. It's not a requirement currently, but I think it's an unwritten rule. Boards that I've sat on, I chaired a select board for 29 years, and anytime we were going to go on executive session, it was always on. I know other school boards, it just gives the public the knowledge that you could be sitting around for a while waiting for them to come back. So, and it's just transparency. I did have a conversation with the executive director of the BEPSI board a short time ago, where I was assured that they will be posting that. But I think in talking with VLCT, I also talked with the chair of GovOps, and we think that it just makes sense to codify it, what the current practice is, and make sure all the boards are doing that. So that's what this language does. And I thought it was a good place to put it, because we had talked about, the open, when we had discussions with BEPSI, we talked about the open meeting law quite a bit.
What action is appropriate, Madam Chair?
Any questions?
Yep, quick one. On some of the boards that I've had, I would get an agenda that says executive session if needed. Is that would be all right in this case, as long as you don't have to specify why the exec, at the time you would, but on the agenda, you wouldn't need to specify why.
Not necessarily, but if the public knows that there could be an executive session, I mean, I think most boards, if they know that there's going to be an executive session for a particular issue, they'll post that. Other boards may put it on there as a catch-all just in case.
That's
because, you know, sometimes you don't know if something pops up.
I hear what you just said. But if you always have it as a catch-all, it's not much notice. So, it's just like, then it's if needed, and you're really not signaling very much. So the public doesn't know any more than it would know. Go ahead. I just, that came to mind when you said that.
May I?
Right, Representative Marco, do you have any?
No,
Okay.
I think generally boards post when they know they're going, when they anticipate there's going to, and the reason why. It's either going to be, for a personnel issue or something. There are times when in discussions that the boards are having on certain issues that they may find that they need to go in executive session because some things are coming up that shouldn't be let out to the public at that point. And so they would go. And that, I think, is what Kurt was talking about.
Under number 4, it's crystal clear that if you know, you state it, you don't say if necessary.
Anything else? Because it's on the calendar, we struggle. So, all those in favor?
Aye. Aye.
Opposed?
This actually came up in.
So 12, I think that was 12-0-0. Okay, thank you.
Thank you, Mike.
Good, thank you.
We are off the floor. We will be back, or off whatever we're in. We'll be back here tomorrow at 9. And just so everyone's aware that we have the floor on Monday.
At 1.
At 1. Yes, at 1 on Monday. We might also meet on